After graduating from dental school, I was a huge Dave Ramsey follower. Live below your means, work harder, maybe even pick up a second job. That's the advice that many popular financial gurus typically give, including those like Dave Ramsey and Suze Orman. And to be fair, in many cases, that advice is incredibly helpful, especially for those who are trying to get out of debt, build discipline, and take control of their financial future. But let me ask you a question. What if the truly wealthy do the complete opposite? And to answer that question, we'll be discussing some key concepts in today's video from the book Rich Dad Poor Dad, written by Robert Kiyosaki. If you're new here, I'm Dr. Adam Corin, founder of The Dividend Dentist, and my goal on this channel is to help you achieve true financial independence and time freedom with passive income. So let's get started. So before we begin, you need to understand one key difference between the wealthy and everyone else. And that is, the wealthy don't work for money. They work to acquire assets. And once you understand that key distinction, everything that follows begins to make sense. So if you've ever heard phrases like the rich get richer or the rich pay the least in taxes, today's video will explain why. And to understand that, you have to know what an asset and liability actually are. Assets are simply things that put money in your pocket while you own them. On the other hand, liabilities are things that take money out of your pocket while you own them. And here's where many people get confused. It's not necessarily what something is, it's how it functions from a cash flow perspective. Let me give you a few examples of an asset and a liability in each major asset class. We'll start with real estate. Take your personal residence, for example, that you live in, pay a mortgage on, and work to maintain. That's taking money out of your pocket every month to own it. Versus a rental property, or things like REITs or real estate crowdfunding, that actually pay you on a regular basis to own them. Now let's look at stocks. Take your 401k or other retirement account. That may grow in value over time, but doesn't pay you to own it today, and takes money out of your pocket every month to fund it. Versus dividend and interest paying investments that are putting cash in your pocket today. And lastly, we have business. Take your dental practice or a business that you work in and operate in every day, where if you stop working, the income stops too. Versus a passive business, brand, system, or even a franchise that runs without you day to day and continues to produce regular income. So always ask yourself, does this pay me or does this cost me to own it? And this is a common mistake that the middle class makes that we'll discuss later in the video. Many people in the middle class own liabilities that they think are assets. Things like your home, cars, and retirement accounts. But remember, if it doesn't pay you to own it, it's not an asset. It's a liability from a cash flow perspective. So next we need to understand something called the cash flow quadrant. The cash flow quadrant simply determines how you earn your income. As you can see, on the left side of the quadrant, we have E and S, what Kiyosaki also refers to as the poor side of the quadrant. E stands for employee, and S stands for self-employed, small business, or specialist, like a doctor, lawyer, engineer, accountant, etc. The left side of the quadrant is where most dentists and other high-income professionals live and operate, meaning you're either working in a practice or a hospital as an employee, or you own your own practice and work in it day to day as a self-employed individual. Now, I want to be very clear. There's absolutely nothing wrong with the E and S quadrants. But here's what happens, and it's a common mistake that many high-income professionals make without even realizing it. Most people spend all of their time and energy either climbing the corporate ladder as an employee, or they go out on their own to be their own boss and start their own business or practice as a self-employed individual. The problem is they stop there and never make the shift from the left side to the right side of the quadrant. Both the E and S quadrants are still playing the same game. No matter how much money they make in each quadrant, they're still trading time for money. And that's exactly why Kiyosaki calls this side the poor side of the quadrant, even if you're earning a strong income. Because if your income depends entirely on your time and presence, it doesn't scale, and the income stops when you stop. Now let's move to the right side of the quadrant, where we have B and I. Kiyosaki refers to the right side of the quadrant as the rich side. B stands for business owner. And Kiyosaki often says that the B quadrant represents owning a business with 500 employees or more. But for most high-income professionals, this doesn't have to be the case. This could be things like a brand, book, content, or any system, even a franchise, that produces steady income without requiring you to be there all the time. To sum up the B quadrant, this represents systems and people working for you to produce income. And then we have the I quadrant, which stands for investor. This represents income received from things like dividends, rents, interest, and capital gains. To sum up the I quadrant, think of this as your money or capital earning passive income for you without requiring you to be there all the time. And here's the key shift. The wealthy aren't trying to climb the corporate ladder or continue to work in their own small business. They're building or buying systems and investments that gradually replace themselves over time. And here's where things get really interesting and fun, in my opinion. In his books, Kiyosaki often refers to what he calls the BI loop. And here's how it works. Let's say that you're earning a high income as either an employee or self-employed person on the left side of the cash flow quadrant. And then you build a B quadrant system that produces passive income. You then take that income from your B quadrant system and invest it in the I quadrant, like so. And over time, those investments start producing their own sources of passive income. You then take that income and reinvest it back into your B quadrant business or system, or you use it to acquire more assets. It's a loop, and over time it compounds and becomes scalable. And this is the secret to transition from working for money on the left side of the cash flow quadrant to having money and systems work for you on the right side of the quadrant. It doesn't happen overnight. Making the shift from the left to the right side takes time and effort. But the most important part is the mindset shift. Because once you start thinking in terms of assets, every decision you make from that point forward starts to change. This also explains why the wealthy typically pay less in taxes. Employees and self-employed individuals earn active income, which is taxed the highest, whereas the wealthy earn the majority of their income from passive and portfolio income sources. And these types of income are taxed more efficiently. So when you hear people say things like, you can't tax the rich, this is often an exaggeration, but there is some truth to it. Meaning if the government raises tax rates on earned and active income from a job, it doesn't affect people on the right side of the quadrant as much because their income comes from different sources. And this is where everything comes together. When we start talking about financial statements, including things like income statements and balance sheets. Now, most people focus strictly on their income statement, how much they earn from their job, and how much they spend via expenses. As we discussed earlier, even many financial gurus typically focus on this one form of financial statement. So when Dave Ramsey says, work harder and cut up your credit cards, again, it's not bad advice, but he's typically recommending that people work longer hours, earn more money, and cut their expenses as much as possible. So let's talk about the cash flow pattern of a poor person, and it looks something like this. They earn income from their job, and it flows straight out in the form of expenses. Then you have the middle class. Again, they earn income from their job, but then that income flows out in the form of liabilities. And this can include things like mortgages, car payments, student loans, credit cards, etc. Things that they think are assets, but are actually liabilities in disguise, because they cost them money on a regular basis. And then we have the wealthy that flip the model entirely. Instead of focusing on increasing their income and cutting their expenses, the wealthy focus on assets first. This can include income sources from things like rents, dividends, interest, and capital gains. And it looks something like this. The wealthy acquire income-producing assets that then flows income into their income statement, which in turn covers their expenses and pays for their liabilities. As you can see, it's an entirely different game. And here's where the magic happens. Once you acquire enough income-producing assets to replace your expenses and cover your liabilities, that's when you reach financial freedom, or what many people call getting out of the rat race, where you work because you want to, not because you have to. So just remember, the truly wealthy never ask, how much do I make? Instead, they ask, what do I own that pays me? So instead of working harder and cutting your expenses, start buying assets that replace your expenses and provide true financial freedom and optionality. Because remember, the left side earns income, but the right side owns the systems that produce it. If you liked today's video, please remember to hit the like button and subscribe to the channel. I'd really appreciate it. Also, drop a comment below and let me know your thoughts. I'd love to hear it. What assets are you building right now? Thanks for watching, and as always, I'll see you in the next video.